Hello, welcome to the Economic View. I'm joined as usual by Evan Lucas, our market strategist. Hi, Evan.
Hello, Tony. How are you?
Evan, the OECD has come out and made some quite interesting comments about the Australian economy, particularly in the context of interest rates and the Australian housing market. I found them interesting in the sense that the OECD is pretty much sort of telling the RBA what it wants or what it thinks that the RBA needs to do in terms of the interest rate policy for next year.
Yeah, it is. And look, it's also interesting. I mean, it's the largest economic think tank on the planet. We are a paid-up member. We do take a lot of insight out of what they do. I would also highlight that a lot of what they've been said, probably over the last 5 years particularly, has sort of fallen on fairly deaf ears. And to a point, I think the best example to give you is what the Fed has said to them a couple of times over the last couple of years, which is basically to nick off. Again, they have a valid and legitimate reason to say what they're saying. And it's not new. It's not something we don't know, which is that if you look at debt to income, if you look at the household debt levels, all those highlights that they've put out in the report has been coming out for probably the last 18 to 24 months.
Yeah, no surprise, is it?
Yeah, and it shouldn't be. I mean, it would be they are an economic entity that should be highlighting these kinds of structural issues and risk factors inside the market. They also highlight the fact that we have a very, very concentrated group of banks with a really, really, what their word is, too big to fail issue, which again is not new. I don't think any of that should be taken. What is hard to swallow with regards to what they're talking about is, as you said, pointing to raising rates in 2018. Now, we know that the RBA under Philip Lowe wants to do that, but what they're saying is that they should possibly be considering doing it outside reaching their mandate, which is we think you should be considering raising rates even if the inflation target isn't reached to cool off the housing market. Now, that is a pretty big comment to be making, because from where I sit anyway, the ability for the RBA to communicate that to the economy without creating big shocks, I don't think they have the capacity to do that. I mean, you'd have to be of Shakespearean ability to write and communicate to really make sure that everybody's calm and understanding why this is. And this gets back to what you and I have talked about many times on this program, is interest rates are a sledgehammer. They're a blanket tool across the entire economy. Yes, housing market and debt levels are a headwind, and they could be a structural issue. But the impact that would have on confidence, the impact that would have on investment. I mean, we're getting the CapEx numbers coming up this week. If you were to see a rein-in of rates and an increase on that and a pressure on business investment by rates increasing on business lending, where does that go through to? Wage growth is already at just off record level lows, and complaints about them not filtering through. Business is going to close that up like tomorrow. You'd also have a scenario where growth, which has been a bright spot and is showing signs of actually getting to, oh yes, they're below historical levels, but back to levels that are a little bit more sustainable, consumption would go through the floor, and it makes up 40 to 42%. So it would be a really, really interesting signal to the market that actually our number one mandate, we're going to have to put that to one side because of one structural problem in our economy. Yes, it's a big part, but in saying that, to do that would be a big change in direction, and it would certainly hit confidence and investment very, very quickly. So what they are talking about, which is a medium-term problem, the short-term reaction, I think, would well and truly override the reason to do it.
When you get the likes of the OECD coming out with these types of reports, though, and essentially the federal government and the RBA are meant to be, separate entities. I mean, that's been talked about plenty of times in the past.
And whether or not they really are.
Well, yeah. But the OECD, coming out with these sorts of fairly heavy-hitting type statements, on what should be happening in the Australian economy. It puts a lot of pressure on the Reserve Bank to, rethink its policy in a way, doesn't it?
It does. But getting back to the OECD paper from last night and talking about the break between monetary and fiscal policy, does very clearly pick up on the fact that it wants the government to get back to what it promised, which was fixing the structural issues in the budget.
Yeah.
And that's the monetary fiscal policy side, issue of this. Again, what you've been hearing over the last 4 to 5 weeks is probably why they're putting that in there. The fact that you're hearing talk about middle income tax cuts, whether or not we start following a US style movement around around business tax issues, all that kind of stuff. That's, again, structural money out of the budget. You know, does the cyclical movements to the upside in the commodity space, which does add quite a nice little buffer at the moment in the budget bottom line, offset what's going on there? All that's a good question. But you're right. I mean, monetary policy has been the heavy lifter in the post-GFC world. It doesn't matter where you look. And again, the one you always highlight is the US because it's so good at communicating its current space.
I was going to say, let's move to the US now and just talk about what's been happening over there with the incoming Fed chair.
His testimony to Congress last night was a big positive for growth and a big positive for risk securities, equities. It is, as people somewhat suspected, listening to what he said, that the gradual rate rises could go to almost glacial. I mean, if you listen to what he said, he was very polished, and that should be what you'd expect from an incoming Fed chair. He was pushed very heavily, particularly by Democrat senators, around what's going to happen in December, what's expected in 2018. And the statement I picked up very clearly is that if he was nominated as chair, which clearly he's going to be, he will continue to make sure they move towards their target, which is full employment, their targeted inflation band, and therefore looking at making sure policy is moved around that. But he put a huge caveat when he said, however, we will do that off the back of what is going on in the economy, and we need to have the ability to move if the economy faces shocks. And that is the biggest get-out-of-jail-free card statement I've seen in a long time, which, again, is why the market is pricing in the idea that 3 rate rises is just not going to happen in 2018, despite the dot plots telling you so. And that's this positiveness that got out of what's happened in the US overnight. Yes, a lot of people point to what happened with the Black Friday sales, Cyber Monday sales, and the Dow having a 200-point movement with Amazon hitting another record all-time high. But what he said is clearly what people were expecting him to be, which is dovish again than Yellen, and that is clearly what he said in the statement around his testimony to the Senate last night. Yeah,
so we've seen a real change in pace from the Fed, or we're likely to see a real change in pace from the Fed, from a very sort of hawkish, let's get interest rates ratcheted up into 2018. It's going to move much more slowly.
He was saying that he was expecting to continue on with the current policy stance, but there was definitely, as he said, there's an underlying tone there that the speed may be too fast. So instead of having 3, probably more likely the Fed will start forecasting 2.
Yeah, which will have implications for what our Reserve Bank does, starting back at the beginning with the OECD. The Reserve Bank's got to sort of weigh all these things into consideration.
They do. And this, I mean, the part that we're not talking about is when you go a little bit more granular, get away from the macro stuff and actually have a look at, yes, the RBA's got a big eye on the Fed. It's got a big eye on China. It then has an eye also on the domestic movement of our private banks. And that's what's also happened. And they do highlight that. Macroprudential rules are clearly working. They are slowing down our housing market, which is a positive. We're consistently now seeing under 70% clearance rates in Sydney and Melbourne. So there is movement in that space. I think you've also got to highlight the fact that the private banks are getting pressure on the wholesale market. Now, I think the RBA was probably hoping, I think that's the way to put it to you, that the raises of rates in the US would put more pressure on private lending because as they refinance new rollovers of debt facilities in the US with new higher interest rates, that would put a brake on them lending it out or increasing the rates they lend out. Again, it's a natural pull, isn't it? And that's a lever to slow it down. So you're right. The US Fed is a big impactor also on our housing market because our ability to borrow, we can't fulfill it with the amount of money in this country. We have to go to wholesale markets, and that is the States. So a slowdown in rate rises just adds a little bit of another headache to the RBA around this whole conundrum.
Thanks very much, Evan.
Thanks, Tony.
Join us again next time on The Economic View.